We're excited about another great webinar in our series, and this actually is going to be a fun webinar because this is one of my favorite topics. Believe it or not, it's true. I am so inspired by the possibility of people setting their intentions through the power of cash flow projections. And so today the webinar topic is Shaping the Future. That's the future of your business with cash flow projections and cash management. And we have a wonderful guest, but before we get started, I do want to just thank you all for being a part of the webinar and make sure that you know how to use this platform. There's a little arrow on the upper right-hand corner if you want to minimize the control panel. You're welcome to. But we do have the opportunity for you to ask questions throughout today, and how you would do that is you click on the question arrow, and then you type in a question or a comment, and then I will be asking the questions verbally of our presenter today. So please ask questions as you think of them. We'll set aside time at the end, but we may ask a few as we go as well. So I hope you enjoy the webinar, apply it to your business, and this webinar is brought to you by Jefferson Economic Development Center, also the proud host of the Women's Business Center and the Northeastern California Small Business Development Council. We are pleased that we're able to support so many people in the region in the training classes and workshops and private business and financial consultations, really supporting small business owners in growing, expanding, getting started. And of course, those of you familiar with JEDI know we have a lot of different services, including tax preparation, business planning, loan application help, and advanced business development services. So our telephone number 926-6670, and we have a new website. If you haven't checked it out, it is ejedi.org, e-jedi.org. All right, so let's get into the numbers with the woman who has inspired me more than anyone else to really have fun analyzing my financials and using my financials in new and creative ways to really support myself as a small business owner, but also as a facilitator at JEDI to help other people do the same. So Susan Brown is here in Mount Shasta, but her clients are throughout the United States. She has 25 years of experience in business and community development. Her specialties are financial analysis, like really letting the numbers tell stories to help and empower business owners in making smart decisions. She helps people with business lending, organizational development. She's a fabulous facilitator and educator. She's been with JEDI for years in various roles, currently also on the faculty of our Power Up program. So you can learn more about Susan at susanrileybrown.com. And right now, I'm going to just give it back to you, Susan, to enlighten us on cash flow projections and managing our money wisely as entrepreneurs. Thank you for being here.
Good day, everybody. Hi, this is Susan Brown talking. Thanks for joining us. And what we're going to be doing today, we kind of have a two-part presentation. You get two for the price of one. We're going to go over what a cash flow projection is, how to use it. I'm going to show you some examples and demonstrate it for you. And then the second half, we're going to, well, not the second, the last third of my presentation is on cash management strategies to help you manage your cash wisely. So, which is related to a cash flow projection, and we'll talk about that more later. And please do ask questions in the text box. I'm happy for Joy to interrupt me as we go along if you have questions along the way. And I plan to stop about, I'm hoping to stop at 12:45 today to allow plenty of time for questions at the end. So let's just jump right in and ask the question, what is cash flow? It's the movement of cash into and out of your business. And I'll explain this much more as we go along. But the real trick about it is the timing of inflows and outflows. And I created this little chart sort of as an example. Depending on the type of business you have, you could have a situation where you're sales are very steady, that would be the blue line. You know, you kind of have an even sales situation, but for some reason your expenses have a lot of peaks and valleys. This is particularly true with businesses that have to do large inventory purchases, or maybe do occasionally large equipment purchases, something like that. So you can see there in that case, inflows and outflows do not match each other, and you can see places where they may run out of cash. You can reverse the situation and say that maybe your expenses are pretty stable, but your revenues go up and down, again, because of seasonality or some other factor in your business. So it can be really challenging for businesses to manage their cash because the money coming in and the money going out don't coincide well. So let's talk about let me break down some of the terms here for you. So what is a cash inflow? Mostly it's sales from your business. That's you know, the biggest inflow of cash usually in a business. There's a couple other options though. It could be new money coming into the business in the form of equity. That's if you take some money from savings or wherever your source is and you decide to put more money into your business. That's an equity investment, and that happens in businesses from time to time as they're growing. They need more money, they need more working capital, they shoot in some additional money. Another way new money enters a business is through financing. Sometimes people get loans, they'll do a line of credit. There's various ways you can get financing to help run your business, and you would show that in a cash flow. You would show that cash from a loan coming into your business. Occasionally people also get new investors in their business, so you might get a partner or some other kind of situation where you get new investment in your business. So those are the ways money can come into your business. Now, how does the money go out? Generally, it's most of your expenses. It's all your standard business expenses, like your telephone and your your internet expenses, material supplies, labor, whatever you spend money on to run your business are your outflows. If you buy new equipment or do an inventory purchase, that's an outflow of money. Obviously, owner's draw or salaries, that kind of thing is money coming out of your business. If you're making loan payments, those of us who are self-employed and are sole proprietors or have partnerships, we pay estimated taxes quarterly. But even if you're a corporation, taxes are coming out of your business on a regular basis. You might have a new growth opportunity or a new project to start, and you've got to invest some money in it to launch it. And then there's just emergencies. Life happens, and emergencies happen, and the unexpected happens. So those are all the ways money can kind of leave the business. So again, the trick really is this question of timing growth and the unexpected. Sometimes bills have to be paid before you get paid. I wait, I'm a consultant, so I wait anywhere from sometimes a month to 3 months to get paid. And in the meantime, I have my bills to pay. So some of us are waiting to get paid by our customers if we don't have a cash business. Sometimes you have to buy large chunks of inventory for various reasons because there's minimum purchases, because you get a discount, who knows. But you might have to pay for a bunch of inventory before you have time to sell it. In fact, that's usually the case. You've got to buy inventory, make your product, stock the shelves, and then sell it, and then wait to get paid. So you've shelled out a bunch of money, and you've got to wait till that money comes back in. Very fast or very slow growth obviously can affect your cash situation. One would think, oh, fast growth is great because I'm making a lot of money. Well, sometimes fast growth chews through cash, and you can actually run out of money if you're growing rapidly. So either very fast growth or slow growth can be situations where you run out of cash in a business. Again, new opportunities or projects, unforeseen emergencies, and seasonality. Many people in our community have seasonal businesses. They work in the summers, or they just have something at Christmas, or their winter business, and that impacts cash flow greatly. You have to do a lot more management of your cash. So our solution is the cash flow projection, and it is a tool to help you anticipate bumps in the road and these weird inflows and outflows, the timing of these inflows and outflows of cash. So it's a perfect tool for that. It's a tool to make sure you have enough cash to keep your business going, which is a central management task for all of you. Without cash, we can't really run a business. We kind of it's sort of like having a gas with no car or a river with no water. We got to keep that cash flow going to stay in business. So let's talk about what a cash flow projection is. It is a financial statement. It's considered a financial statement, and it uses a business's history plus assumptions about the future to show how cash is expected to flow in and out of the business over a specified period of time, usually 12 months, to see if projected cash inflows will be sufficient to cover cash outflows. So that's kind of fancy way of talking about it, but basically it's, you'll see in a minute, it's a tool that we create in a spreadsheet program. I use Excel, and it helps us. It does help if you have some history, because then you've got some more data to figure out what the next 12 months is going to look like if you've got some data about the last 12 months. But if you do, and you've got some assumptions about where you think you're going, as Joyce said, it's a great tool also for setting goals, for making management decisions, because you can use it to sort of play with what am I going to do over the next 12 months. So a profit and loss statement, which we're not talking about today, but it tells us little about actual cash flow, which I know is counterintuitive perhaps for some of you, but your bank account balance and your profit and loss statement, if you have one out of QuickBooks or some other program, it may tell you whether you're profitable. It may tell you very little about your cash situation, depending on the type of business you have. So profitable businesses can go out of business for cash flow reasons. So why is this? Well, many uses of cash don't show on the profit and loss. So you've got money going out the door that don't show on your P&L. Taxes, loan principal, inventory, owner's draw, new capital investments. There's a number of things that don't show up on the P&L, and yet that's money leaving the business. So if you're just using a P&L to sort of figure out where you stand, you're kind of driving with one eye, covered, one eye situation. Obviously, seasonality, you can run out of money easily with a seasonal business. If you have a very long operating cycle, if you're somebody who makes a product or you wait a long time to get paid, this is where cash management becomes really critical, because you've got this long operating cycle where you're taking a long time after you invest a dollar to get it back into the checking account after a sale is closed. Sometimes people make investments that don't increase profits. Those poor investment decisions can make you run out of cash. And if you have a fast-growing business, you can outpace your profits. That's not uncommon to have happen. So the benefits of cash flow projection, it gives you visibility to anticipate what are called liquidity problems. And liquidity problems are just, do I have enough cash to keep operating month after month, year after year? So it's a way to sort of have some, crystal ball a little bit into the future and use as a planning tool. It can assess what you can afford in terms of new equipment, owner's draw, new location, and expansion plan. A lot of people dive into those things without and sort of thinking it through. Cash flow projection is a great way to think those things through. As I said, you can set goals for sales. Like some people go, gosh, what's my break-even point? Or if I want to make $1,000 a month or take home $3,000 a month, what do I need to sell to even get to that place? Well, a cash flow projection is a great tool to help you figure that out. We can back into sales, a sales volume goal, based on what you want to take home and based on your expenses. You can also set limits on expenses if you need a budget, if you're not sure how much you can afford or what you can spend. If you're interested in financing, a cash flow projection is a great way to prepare for a loan, to roll a loan payment into your expenses and see what that looks like, see if it ups sales enough for you to afford to pay it back. It also might be a document you actually include in a loan package to qualify for lending. Again, it helps you manage seasonality, and I think this is what Joy likes about it so much. It helps you paint a picture of possibilities, like what if. You get to dream about the future and play with things when you do a cash flow projection. So there's a few rules we want to go over. What you want to do, again, I don't know everybody on the call. I don't know your backgrounds, but if if you're familiar with a profit and loss statement, this is not like a profit and loss statement. It's different. So what we want to do with cash flow is show all sources of money coming in when it enters the checking account. So even if somebody owes you money, it may show up on your P&L as a sale, but it's not going to show up on your cash flow projection until you know it's going to hit the bank. So if you know you have to wait 60 days or something like that to get paid, even if you make a sale in January, you're not going to show the money coming in until March or whenever you typically get paid. So, and the same is true with money going out. All money going out, you show all money going out, those outflows, when it actually leaves the checking account. So even if you owe a bill and it's due in March, if you don't show it on your cash flow projection, so you're going to kind of write the check and it's going to leave your checking account. And again, we show cash outlays that aren't on the profit and loss statement. Again, that's often income taxes, loan principal. If you do a P&L, only the interest shows on your P&L, but on a cash flow projection, we're going to show your whole loan payment, the interest and principal. Inventory, again, sits over on the balance sheet, typically if you're doing your books exactly, but on a cash flow projection, we're going to show all your inventory purchases as soon as you pay for them. Owner's draw, new equipment and expansion expenses, all these things that sometimes either over on the balance sheet, which is a document most of us don't look at very much or don't understand, we want to shine a light on them in the cash flow projection. So when I say play with the structure, I really do mean play with the structure. I know people don't think about financial statements and spreadsheets and stuff like that as toys to play with, but I want to invite you to think about it that way. I am going to show you an example in a little bit, but what I show you doesn't have to stay the way it is. A cash flow projection is something that can morph and be adapted to your particular situation, not only to sort of match your business structure, but also to match your head and how you think about your business and how you think about what's going on in the future. So it is a very editable document, a very editable financial statement. There's a lot of rules about other kinds of financial statements like P&Ls and balance sheets. But cash flow projections, we have a little more flexibility, and I want to invite you to think about it that way. It does use an Excel spreadsheet. If you're not familiar with Excel, I invite you, and Joy is, I know some of you are in her It's Your Business class. She's probably told you about lynda.com. There are places to learn how to use an Excel spreadsheet. I'll give you an ultra mini micro introduction to spreadsheets today. But if you're completely unfamiliar, you do want to get just the basics down. You don't have to know much, just a little bit to use them. And JEDI can help you complete your cash flow projection. So, and what I'm going to show you a couple of spreadsheets, and what, if you're interested, Joy will give you instructions at the end of the webinar today to help you know how you can get samples of these files I'm going to show today, because we're happy to email them to you if you just give us an email and say that you'd like those cash flow projection files that were used in the webinar. Okay, so let's actually look at a cash flow projection. So I'm going to have to hop out of this and hop into something else, so hold on. So there we go. So let me walk you through. This is a sample, and this is a very simplified one. So cash flow projection. I'm going to show you a second one in a minute that's a more typical cash flow projection. But I do want to say that even this very simple one, if you extended it out 12 months, I'm only showing, what, 6 months there. If you extended it out 12 months, this is a perfectly good structure to have if a simple model helps you. So, and simple is easier to learn on, so I did a simplified version to help us get comfortable. So we're sitting in an Excel, which is a spreadsheet program, and what spreadsheets do is they give you all these little boxes. You see me clicking on these boxes. Each box is called a cell. And in each cell, you can do one of three things. You can type a number, you can type a word, or you can type a formula. So what you'll see me do here today is, as you can see in the box like this, February, our months, I've typed words going across on the months and down on some of those account names. And then I'm going to be typing numbers in some of these white boxes here. And then in these, I colored these boxes gray because there's formulas in those boxes. And I'm not teaching formulas today, so if you don't know anything about Excel, that may be a foreign concept for you, but you can actually, tell Excel cells to add, subtract, multiply, divide, compare, compute. There's a million things Excel spreadsheets can do. So when I go and fill this in for you today, I'm just going to be typing numbers into the white boxes and leaving the gray boxes alone because that's where the preset formulas are that make it work. So what you'll see is that, again, usually this would be 12 months. I just did 6 months to make it easier for us to see. And let me see. Yeah, so what we have in the columns is we have months, February, March, April, May, June, July, and again, you usually go out to 12 months. So a typical spreadsheet is a 12-month document. So you'd have full 12 columns going across by month. And then coming down in this column A, in these rows, we have our incoming monies. I wrote, again, this is simplified, so I did sales and just opening cash. And you add those two together and you get total cash available. As we march down column A, then we subtract from that all our operations expenses. So I'm kind of assuming this is like a restaurant or a food cart or who knows, something like that, where there's food purchases, wages, there's a rent payment, phone, office supplies, your typical expenses. And utilities, taxes and owner's draw, again, would normally not be on a P&L, but we do want to show them on a cash flow projection. So we add all our expenses together, and in that cell that has a number 19A, we'd get our total expenses. And then net cash is basically our total cash available, which is cell 7, A7, minus total expenses, which is A19, will give us our net cash. So that's the structure of it, okay? So the one other thing you need to know about this is the reason this is called a cash flow projection is because the closing cash, which is down here in, let's say, B21, when I add some numbers, you'll see it'll calculate a number there. That's our closing cash for the month. That number is going to get transferred up into this cell up here, which is C6, which is our opening cash for the next month. So closing cash in February, the last day of February, becomes opening cash in the beginning of March. Closing cash at the end of March becomes opening cash in April. Because whatever you sort of have in the bank at the end, last day of March, is what you have available the next morning in April. And that's how we kind of see how cash, the inflows and outflows are running through the business, again, sort of like a snake or a stream or a river running through. So let me add some numbers here so that you can kind of see how it works. So let's say you started your cash flow projection in February, you're up and running, and you've got some money in the bank. So we're just going to have an opening month, just to start there. And as you can see now, it did calculations for me. It said that if I have opening cash in February of $1,000, then my total cash for that month is $1,000. There's no expenses of $0, so my closing cash is $1,000, and that the formula transferred that closing cash in February to the opening cash here in March. All right. But let's add some more numbers and say that we have some sales. But February, let's say we have a sort of seasonal business, and the winter months are a little bit slow. So I'm just going to make up some numbers here. Let's see how it goes. Oh, excuse me. So as you can see, I'm just making up numbers. Now, if you had historical data from a profit and loss statement or even a tax return or something like that, you might have very specific numbers, and you kind of know what a typical March is or a typical April is for your business and what sales looks like. So I added some sales numbers, and as you can see, again, Excel added them together here on line 7 for total available cash, and we don't have any expenses yet, but it's doing the math for us and adding up all our sales together. So let's add some food purchases. Now I'm just going to go ahead and actually do a formula here and assume that our food purchases generally are about 30% of our sales, because that's kind of typical for a restaurant. And then you see I put a little formula there, and I'm not teaching formulas today, but you can get help with this, and then I can drag that across and kind of anticipate. I know historically that my food purchases in my restaurant are about 30% of sales. So there we have our food purchases coming out of our income. Then I've got some labor, and maybe it's not very high, but it increases with time. I've got, oops, excuse me, I've got a little, I've got more and more labor costs as the months go on because I need more help at the food cart or whatever. And then I've got my rent. So one of the things you'll see me do is I put in a number, and then again, if I drag this little box in the corner across, it just spreads either the formula, the cell, the word across for me. So I've got my phone and internet expenses. This day and age, I don't know about you, those can be kind of high, so we'll spread those across. I have minimal office supplies. So as you can see, what I'm doing is it's spreading things across. My utility bill is pretty steep, and it kind of goes up as the year goes by. So let's add a little more money there. You can kind of see as the season picks up, my expenses pick up. That's typical if you have a kind of a seasonal business, something like that. And as you see, what's happening is we had our expenses, our net cash is going lower and lower. And I know in April I'm going to owe taxes to the government, and I'm going to owe that again in July. Those of us who pay quarterly estimates know that that's what we do those months. And then owner's draw, like, to make this worth my time, I just got to get, $500 a month out of this. So let me see if I can pay myself $500 a month. Well, so there we go. I filled it all in, and what we see is that we get in a negative position. This red number here in April at the bottom, we have a negative number. So I've been projecting into the future, and it's like, oh gosh, I can't pay myself that much, or I have to increase sales. So what we realized is if I just went ahead with this plan with blinders on, I would run out of money in 3 months. I wouldn't have enough to keep operating. So this is what's great about the cash flow projection. Remember, it's like it gives you visibility into the future liquidity of your business. So what we want to do is say, okay, let's play with my assumptions about how I'm going to run my business. And in a case like this, you have a few options. You can say, look, I've just got to figure out how to increase sales. My sales have to increase. Or I'm just going to not be able to pay myself in the slow months. Or I'm going to get a loan to sort of carry me over during the slow months, and I'll pay it back in the later months. So this is where you start to strategize. Or I can't afford my, my wages for my workers, in the slow months. I'm going to just have to do it on my own. And that's what I mean by this is where you start to play with it. What are my options? What could I do differently? How can I say yes to this and no to that to make it work better? So, what I'm going to assume here is that, we take on a marketing plan with Joy's help and decide, I'm just gonna figure out a way to get those sales up, over last year. It's just going to be a better year for me, and I'm going to make more money. And in the meantime, I think I'm just going to have to say maybe I can't pay myself for 1 month. And let's see, maybe I don't have any help for a couple months, and I just kind of do it on my own. Just by making those changes, at least now we're in the black. We're not in the red anymore. As you can see, our net cash, we have enough cash to keep operating. And again, you just want to do this in a way that works for your business and plays with your assumptions and helps you figure out how to move forward so that you can, have enough money going. So that is our simple cash flow projection. And again, this document can easily be made into, because if I highlight this whole row, it's actually pretty easy to spread this out. 3, 4, 5, 6, 6 more months, and edit it and make it a full year's thing. So if you have a simple business and you're new to Excel and you need a simplified, this works perfectly well, and you can get some help from JEDI to make this work for you. And you can see Excel's kind of smart because it saw that I was doing months and it just suggested the month. So Excel is going to help you make it easier. But let's let's switch gears, and for those of you who have maybe a more complicated business or more sophisticated business, or you have a business, you're just more comfortable with Excel and you want something that has more detail, here is a cash flow projection that, let me see, can I get that going? I think that's the best I could do. Okay, so this is a cash flow projection that is a little more typical. One thing I wanted to suggest is you can actually go out and Google cash flow projection on the internet and get a whole bunch of examples. And this is a more typical structure that you'll see on a lot of the fancier models that you see out on the internet. Like I said, there's no one way to do this. So as you can see, we have 12 months going across, just like the other one, but we have more sources of cash. So I've complicated this by just sort of expanding your options. You have beginning cash, like or opening cash, same thing. And we have sales cash. We have collections on AR. AR means accounts receivable. Let's say you sell things on credit or even on credit cards and it takes a few days or whatever. If you have a delay in collecting your money, you want to show that delay. So collections on accounts receivable. Perhaps you have investments and you have interest income. You've received a loan or you have a new equity contribution. There's a lot of different ways money has come into the business, and this format provides a little more detail. The other thing it does is it breaks out the expenses into two forms. This one on line 12 says operating uses of cash, and down here on line 30 it says non-operating uses of cash. I don't want to complicate this for anybody for whom, if you want to get started, don't plug your ears right now and go, la, 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 because I don't want to ask you to take on more than you're ready to take on. But for some of you, what's nice about this, if you have a little more financial knowledge, is that these operating uses of cash are sort of all the expenses that you incur to run your business, to run the buying and selling process of your business, the basic service or product delivery process. And then what these non-operating uses of cash are the things that are sort of, they're sort of like necessary evils that are things like loans and equipment and other kinds of things that, again, often sit on the balance sheet, but they're uses of cash nonetheless. And so what's often useful if you have a more complicated situation where you're compiling inventory and you have a more complicated operating cycle is you do these lines between 12 and 8 and 27 to sort of see, is my business making a profit? Is it generating cash? It'll tell you whether the buying and selling process of your business is making cash. And then these other sources of cash, these non-operating uses of cash at the bottom, then that'll tell you, well, does my business generate enough operating cash to cover my non-operating expenses? So again, it's sort of level 2 cash management in a business, and I don't want to confuse anybody, but for some people this might make sense if you have a lot of buildings, if you have a big inventory, if you have a fair amount of financing. If there's anything like that going on, if you're a corporation and maybe you've got certain kinds of complicated or more complicated ownership structures or money distribution structures, this might be a better model for you. But it works exactly the same way. So again, if I put in beginning cash here, the math behind the spreadsheet is exactly the same. And it will calculate all the income and expenses and the opening cash and closing cash and the exact same way as the other one we looked at. So let me just check the time. So we're right on time, and I'm assuming, Joy, you'd interrupt me if we had any questions. I
got 2 questions for you, actually,
oh,
Susan,
good.
on the cash flow, and one of them is, how can I make assumptions and guess if this is a new business I've never run before? How do you know what to put in the cells?
Yes, I know that is so challenging for a new business, partly because you're new at if you're new to business, you're new at all of it. And then I think a cash flow projection can look particularly daunting because you're trying all those things you need to know to put numbers in those cells you may not know yet. So this is my suggestion is, first of all, get help from JEDI. Padge, Kane, who works there, and other people who work there have enough business experience to help you do some estimates based on your description of your business, your current business structure and what you're thinking of doing. You can also talk to people who are in your industry who have a like business. If you're going to open a restaurant, find somebody in a different town who doesn't see you as a threat and say, you know, I'm trying to anticipate some of these. Like, what are my food costs? You know, can you give me an idea of what your food costs are as a percentage of sales? I'm trying to anticipate what I'll spend on food. You can go around town and say, oh, I need a storefront, so let me research what rents are for commercial spaces around town. It takes more work to do a cash flow projection because you kind of have to go out and do a little more research. But the great thing about it is it'll help you make all kinds of startup business decisions. It'll I've worked with many people. I worked with someone just recently who was new to her industry, and she made some decisions out of the gate, probably without doing a cash flow projection, that kind of weren't to her advantage. And if we had done a business cash flow projection, she could have maybe made different decisions on how to set up her business and sign on the dotted line, so to speak, on certain agreements because she knew what she could afford. The other thing about sales is I think it's very hard to know how much you can sell, and most business owners, in my opinion, overestimate. You know, people go into business with a lot of enthusiasm, and that's good. I think that's really good. And I don't want to dampen anyone's enthusiasm. One thing you can do with these cash flow projections is you can do a best-in-case worst scenario. So take these spreadsheets, make 2 copies, and save one as best-case scenario and save one as worst-case scenario, and just sort of discipline yourself to have kind of low sales and high expenses in the worst-case scenario, and go ahead and, you know, have a rosy view of the future in your best-case scenario, and then have a conversation with yourself or some JEDI consultants or other people who are in business and say, if this were to happen, what would I do? Or how can I anticipate the problems that show up in my worst-case scenario in terms of marketing, in terms of my budget, in terms of sales, and try to anticipate those problems and plan something. The other thing I would do is once you get to a scenario that feels reasonable to you, it feels like, okay, I haven't gone to town on sales, I've padded. The other thing you can do down here, as you can see under other, is I'd put contingency. As you can see, I'm typing it in there right now. I'd put a contingency and just either put a dollar amount or a percentage or something. Put a number in a contingency plan. Just pad your expenses a little bit so you know something unexpected is going to arise, and I've padded it. But when you figure out what your sales need to be, I would say divide that number by the number of days you're open. So if you're a 5-day-a-week businesses, divide your total sales number by, you know, 20-ish days a month and say, can I actually make that much money a day? If I need to make 500 in sales a day and I sell on average meals that are 10 bucks, you know, do the math, and I know I need to sell, I can't remember what I said, $500 a day at 10 bucks a day. I've got to sell 50 meals. Can I sell 50 lunches? Does it seem reasonable to me that I will get 50 people walking through that door every day buying lunches for me? Go to some other business and say, how many actual lunches do you sell a day? And, you know, you can work your way into this, and I know Joy and Padge and other people can help you.
Thanks. You actually answered the second question, which was a question about making a best and worst case scenario. But there's one last question that came in, Susan, and
sure.
How do people use this? The question is, how do I use this ongoing? Do I change my assumptions based on reality?
Yes, we always want to change our assumptions based on reality. That's such a
That was a good question.
I love that question. It's so great. We want to base the reality is going to be your teacher here if you're new. So what you really want to do is always compare. This is the ideal situation. You're going to start a business. First, you actually set up some kind of bookkeeping system so you actually know how much money is coming in and how much is going out. You do a cash flow projection where you project 12 months into the future. Then you hopefully have the time, you're not too tired, each month to sit down with the profit and loss statement, the income and expense statement that comes out of your bookkeeping system, and compare it to your projection and say, where was I right and where was I wrong and why? And hopefully month after month you compare them. so that the people who really are cash flow projection dependent go and edit their cash flow projection every month. So let's say I'm done with month 1 and I've moved on to month 2. You actually delete month 1 because month 1 was just your guess at point 0 about what month 1 was going to look like. So you get rid of it and you just start with today. The cash flow projection always starts from today, not last month, just from today. And say, oh, what I learned from last month, what would I project from here forward? Then you go through another month and you learn some more. Okay, based on what I've learned from 2 months with my business, what would I project for the next 12 months? Then after another month, what have I learned from the last 3 months of my business, and how would I go and amend my cash flow projection for the next 12 months? So I don't want to bog you down with too much work, but if it's a tool that's working for you, you'd go and noodle with it every month or maybe every quarter based on what you've learned to date, and erase the history, start from today, and say, what would the next 12 months look like based on what I know now? It's always a future forward document. Your profit and loss statement tells you about the past. This is telling you about the future. So we always erase the past. If you look at this once a quarter, erase the last 3 months and start afresh with today. And change
Thank you, Susan. That's it for these questions. This is great.
Okay. So, of course, now I've got to get back. Here we go. There we go. So, great questions, everyone. And what I want to do is, I think we have enough time here. I'm a little short of time, but I'm going to go through this a little quickly. What if the cash flow doesn't cash flow? And that's kind of a joke because cash flow projection is a noun, but you can, financial people use it as verb. Does it cash flow? Does the loan cash flow? So what if it doesn't cash flow? We've talked about it. Your sales are too low, expenses too high, not enough working capital. Those are things you have to handle with sales, with budgeting, and possibly with financing. But the last bullet there, managing the cash you have poorly, I want to leave you with, and I'm going to go through this very quickly, some cash management strategies that help you manage your cash wisely. So managing cash is to ensure stability and solvency. It enables you to meet unexpected and as well as regularly occurring expenses. It reduces your risk and provides a margin of safety. So there's cash management strategies along with the cash flow projection will help you achieve these things. So I'm going to give you 6 areas, and each one has 2 or 3 or 4 suggestions. So it's like this big pocket of suggestions, which I'm going to go through, I think, in actually just a very few minutes. So what I want you to do is, as I'm running through this quickly, you can always refer back to this later and re-listen to this webinar. But maybe today just find 1 or 2 that resonate with you, like, oh, I get it, that applies to me, and that would help me manage my cash better. So here we go. We're off to the races on managing cash. So on sales and collections, obviously increase sales. What I always say is, you know, when you do financial analysis of any sort, all roads lead to marketing. It's usually the thing that you have to end up doing to make it get where you want to go. You just got to increase those sales. And Joy's an expert at marketing, so work with her. If you sell for cash instead of credit, you're going to get your money faster. You're going to shorten your operating cycle. You're going to shorten your working capital needs. Collect cash quickly. If you do have to extend credit to customers, collect quickly. Don't let people go a long time without paying you. Get the courage. Work with Joy or somebody at JEDI. Can help you learn how to collect money if people owe you money and they're not paying. Also, you can create a cash reserve. So those are 4 strategies right there. For pricing and profitability, maintain healthy gross margins. Now, we didn't talk about profit and loss statements today. Joy can probably enlighten you on what a gross margin is. But basically, you want markup, so to speak, big enough that you get something healthy so that there isn't just this little thin trickle of cash coming into your business, but we have more of a gush of cash coming in. And margins are your friends. You want healthy margins to get that cash running through your business. Strategic pricing. Again, Joy knows something about this because we did a workshop together where some of your products and services can maybe still sell well with a higher markup than others. Maybe you have lost leaders to get people into the store, and then you have a sales strategy to get them to buy something with a much healthier margin on it. These are strategies to really boost the bottom line and get more cash and more profits into your business without you selling more things. Obviously, if you're making something, if you're producing a product, you really want to maintain efficiency and productivity when creating your inventory. The more time you take, the more wastage there is, the more cash is bleeding out of your business. Inventory. You might as well see inventory as sort of cash on the shelves. You spent money on it, it's sitting there, it hasn't been sold. So ideally, you turn inventory quickly. You keep your inventory low as you can in your business if you have an inventory business. And sell at a discount if something is really just sitting there. If something is just not moving at the regular price and it isn't gonna, get it out. Move it, get that cash, make a better investment. You've learned something buying some inventory that was a mistake. But let's learn from the past and move on, but get our cash out. So don't sit and sit and sit and sit on inventory, because that is just money sitting there, and it's very expensive to you in terms of cash flow. Payables, that means the bills you pay to other people. The accounts payable is the money you owe to others. So if you can shop for deals for a supplier, if you can keep your purchases lower, that is going to help you have more cash, obviously. So if you can just, even if you're not a sort of a deal hunter, if you can do your best to hunt for deals, that will help you use your cash more wisely. If you build strong relationships with suppliers to get credit, you can even get 30 days of credit. If you're an inventory type businesses, it can really help you. And don't prepay expenses if you're short on cash. I mean, some people like to do that, but pay your bills just before they're due. It takes a little more cash management. You don't want people to get mad at you. You don't want stuff to bounce. But if you're low on cash, don't pay things quickly. Wait until just before they're due. Hang on to your money as long as possible, then pay your bills. Financing, that means getting different types of money coming into your business other than sales. You can save cash for operations. In other words, that basic buying and selling is really where you want all your cash located. New people in business often make mistakes. They buy buildings, or they lease big equipment, or they buy equipment they don't need, or they get a really big space, or they do something that just sucks up too much cash. So you want to save cash for operations and lease equipment and buildings instead of buying. And keep your overhead low. It's not on here. Well, that's under keeping expenses low. Have sources of cash for operations. If you can, have a line of credit. Usually new businesses can't get that, or use credit cards. But I have those stars by the credit cards because you don't want to compensate for low profitability with credit cards. There's a whole other presentation we can do on using credit cards wisely. This is probably the most typical way businesses are financed for startup in this country is credit cards. I just don't want you getting in over your head. So you kind of have to know what your limit is on credit cards before you ramp them up. And if you have to buy something big like a piece of equipment, that's what fixed assets are. Equipment, building, something really big and sort of heavy and expensive that has a long use life, you don't want to finance it with cash. You want to get a long-term loan. So if you get a car loan, you get a 5-year. If you buy a car or a truck, you get a 5-year loan. If you buy a building, you get a 20-year mortgage. I mean, you get a loan that matches the use life of the asset. And you try not to put very much down on it, and you try to use financing to preserve your cash for operations. There's sort of an art to all this, which I'm kind of jumping over here, but there is an art to financing, which you can get more help at JEDI with if you need it. Finally, owner's draw, know when and if and how much you can get paid. It's not, you don't get to just say, oh, the business is going to pay me $2,000 no matter what. It's like, if it's there, you get paid. If it's not there, you don't get paid. So that's another good thing about doing a cash flow projection. You can start to see how much can I take out of the business. Remember, operating money, operating cash, working capital is the blood, the gasoline in the engine that keeps everything running. So you can't suck it all out with owner's draw. You have to know how much it can afford to pay you. And then if you have a seasonal business, you really need to manage cash well, have a good savings plan or a job or something like that on the off season so that you can support yourself and not use up all your money. Because if you have, let's say, a seasonal business, it's just the summer, you can't open your business in June with zero in the bank. You've got to have some startup money to start every June. So you can't run dry through the rest of the year. So there, that was like speeding at top speed through cash management strategies. Again, you can always re-listen to this. You can get more help from the JEDI folks if that was a bit fast. But I'm hoping one of those things maybe resonated with you and might be a strategy you could think about using in your business. And we have just about 8 minutes left or something like that, and I'd like to pause and just open it up for questions.
Hey, Susan, at the moment there are no questions, but I encourage people to go ahead and type questions. And maybe while people are doing that, Susan, I'll make a couple announcements and we'll see if anyone has a question.
Okay.
You want to go to the next slide? And,
sure.
We do have a couple upcoming events at JEDI, and Susan, thanks so much for referring people, you know, and I do too, love to do a lot of cross referrals with people here because gosh, we have so many amazing resources at JEDI, one of which is Isabel Moore, who teaches usually twice a year a social media overview for businesses course, and that's happening Thursday of next week at 6 p.m. at the Mount Shasta JEDI office. And if you haven't taken that class in a year or two, you might want to come again because things are constantly changing. Also, Meet the Lenders. This is an annual event that JEDI hosts, and thank you to Padge Kane for being the one who puts this program together. It's full of awesome information on financing, creative financing. There are also going to be some booths and vendors and banks there. You can meet people, ask questions. So if you do your cash flow and you realize it would be helpful to have $5,000, $20,000, $100,000, this is an event you really want to come to. And even if you think you don't need money, someday you might, so it's a great educational opportunity. So also check out our website, make sure you're on the e-news list so you get updated on other workshops that are being offered through JEDI. And Susan, I do have some questions for you.
Oh, good.
Does this work for business and personal, the cash flow? Would it be a different spreadsheet?
Oh, that is a great question. I love that question. No, it's the same concept. And in fact, it's not open on my computer, but had I known this question was coming up, I can show you that I created a cash flow projection for myself that combines business and personal. Because when you're a sole proprietor like me, even though technically I have a business and I have my personal and I have a business checking account and a personal checking account, in the end, it's kind of like one pot of money. So I actually created a spreadsheet that combines them. Or you can do two spreadsheets. You can do one for your business and one for your personal. So it depends. It depends how. If your business is a little complicated, you may want to have two spreadsheets. But in something like, for me, as a consulting business, the financial aspect of my business is quite simple. I was able to combine business and personal and sort of see, can I pay for this vacation? You know, also because I wait to get paid. I wait longer probably than some of you to get paid, you know. So I had to sort of anticipate. So no, it's the same format for business and personal. You can have one for business, one for personal. You can combine them. And for me, when I combined them, it gave me a great overview on what my life financially looked like for the next 6 or 12 months. And I really liked doing that. And I do it from time to time. It sort of depends on my own cash flow. If cash is flush, I don't do it so much. If things are a little tighter, I pull out the cash flow projection and kind of spell it out and see what things look like. So yeah, please do it for personal and business.
I do the same, Susan. I love it. It's an amazing tool for personal and business. So that was a great question. Here's another good question. If you're thinking of buying a business, how can the P&L help you with a cash flow projection?
Oh, great question. Yes. Well, ideally, if you're buying a business, what I recommend is they may give you their profit and loss statements from their bookkeeping situation. But to be honest, I would recommend getting their tax return. Every tax return for a business has, in essence, a profit and loss statement in it. They tend to be more accurate depending on the business, and it's maybe a little closer to reality just depending on all the variables. But that, if you can get a 2 or 3 past years, you can get a really good idea of how that owner ran the business, and then you can ask them questions about decisions they made on sales and expenses and locations and inventory and marketing and all those, staffing and all those questions, and then sort of play it out in the future and say, okay, I hear how they're doing it. Let me think how I would do it, but I'm going to let all that information from the past inform me about how I think I'm going to run this business. The other thing you can do with the cash flow projection is, usually when you buy a business, unless you have like all this money to put down, you have a loan payment to pay the owner. And so you may want to, and the previous owner may not, if they started themselves, they didn't have to pay anybody for that business. So you may have an additional expense that they didn't have. So if I buy a business from someone who started it themselves and they decide, oh, I'll lend you the money to buy my business from me, I may have a $500 a month loan payment to them that they didn't have. So does the business still pencil? Do I still make enough money? Is this still a profitable, attractive business for me if I have to write a $500 a month or whatever check to somebody that they didn't have in their historical documents because they didn't buy it from someone? So that will help you know whether you can afford it and if the business still works financially.
Thank you, Susan. That's great. Really, really amazing webinar, as usual. I think this is going to be a favorite for many people in terms of re-listening to or referring others to. It was very comprehensive, and I'm hoping that everyone who listened in is, as excited as I am about doing a cash flow, because they really, really make a difference in your business health and long-term planning. And Susan, you had mentioned that these spreadsheets are available for people. So what I'm going to do is I'm going to request those of you listening live or listening to the recording, if you email online at e-jedi.org and request cash flow templates from the webinar, we will send those 2 Excel sheets to you. So that's online, O-N-L-I-N-E, at e-jedi.org, and we'll get the spreadsheets right back to you. So Susan, anything else you'd like to say before we call it good?
No, I think I'm done. I hope you feel inspired to give this a shot and get some help with your first cash flow projection. Most of us needed our hands held the first time through, and I think you'll find it a very useful tool if you sit down and spend the time to use it.
Well, thank you again. Thank you again. Lots of clarification in the webinar. And, this is just such a great thing we offer at JEDI. If you appreciate this webinar and would like to support JEDI or become a member, please get in touch, 926-6670. Make the phone call, be a member, and there's tons of benefits such as discounts on our workshops, a really cool mug, resources at the library, and as Susan mentioned, we do have lynda.com for all our members. You have the ability to work with that program and learn Excel if you don't know it now. So we appreciate your feedback. When you close out of the webinar, you'll be asked a couple questions. If you want to give us some feedback on the webinar, we appreciate that. And thanks again to our funders through JEDI, the SBDC, and the Women's Business Center. We are grateful that we can offer Siskiyou, Shasta, Trinity, and Humboldt counties some wonderful training and help boost our economy in each of you. So make it a great day. Thanks for all you do. Thanks again, Susan.
Bye-bye.